or when to capture that carry. But it's important to look at that stuff and ask questions to anybody else around you, and realize, like Scott just said, bean basis may be, because somebody's needs beans today, China's bought the bean basis may be some astronomical high value. Well, if you think, if you see that and you're saying, oh, I can sell it there, I can sure buy it as high. If you can't execute that, you shouldn't be buying it. If you're talking about some kind of DP rate, better cover the offset opportunity loss that we've got by either having to sell that, or what our risk is in carrying that forward through a loss.
Same thing on to-arrive contracts. Sometimes I make phone calls to you guys on people that are, got grain that needs to come in. Usually when I'm making the phone calls, because it's inverted and we need the grain now to pay to fill that price that we paid them. So that's a big reason.
Yeah.
Gotta get it in.
So, for time's sake here, I'm going to let Jeff get going shortly. But this is the opposite for in a short position in a wider carry market. If basis is below 6 over equivalent Chicago option plus your loadout, then as a long, I don't want to take deliveries. I can buy cash cheaper than that. The market's telling me that there's no strain on the supply or demand isn't there. So I'm not gonna go through the delivery process. So as the long futures on the front, I'm gonna have to sell out of those and buy the deferred, which is gonna widen the spreads. And as they do that, the market's rewarding people that can keep grain off the market for doing that. It's paying us more carry. It's paying us more down the road than it is today. We buzzed through that. That's like a day and a half merchandising 101 with a few more details. But at the end of the day, if you remember where you own Chicago grain at, that's a great starting point for basis values, potential basis appreciation. Freight's a huge component in that. And ultimately, it gives us the tie between basis and spreads, and why we as commercial traders are trading a lot of spreads. What DVE is telling us about the market structure. A little bit on future spreads here. Spread transactions are used to minimize the risk of rolling futures contracts, i.e. if currently short March and wanting to carry those bushels to the May, you can use a spread to trade that differential, that gain. Trading future spreads is based on the differential between the 2 months. You trade it in one transaction versus trying to buy back the nearby and sell a deferred in 2 separate trades, which is also called lagging. Trading it as a spread eliminates the risk of slippage in lagging. A little more terminology. Most of the time, and this probably isn't as important for you guys, but most of the time you list the buy side first. So if you're talking about the Dece March spread, probably talking about buying the Dece and selling the March. Visual, the difference, like I said, it's the difference between the 2 outright months, which is normally what most of you guys are probably looking at. Dece corn there, March corn there, the Dece March spread. It's the difference between the 2. When you see a negative in front of the spread, it's a carry market, meaning today's grain is worth more down the road. If you see a positive, it's inverted. Today is higher than the deferred. And why we use them, what it's tied to on the DVE, the basis in Chicago, is in very basic format. Spreads help the commercial elevator determine when to move grain into the cash market. You've heard me say this a lot this morning. Is it worth more down the road than it is today? Is it worth more today and less down the road? That's when I say that, all I'm looking at is spreads. Spreads allow us to quantify a return on our space when there's carry in the market. Full carry is the calculation of storage costs plus interest. talked about on the contract specs, that storage cost. That's a monthly, fixed monthly number. A lot of other factors play into spreads and ability to use them: cost of freight, time, space, and money, logistics, opportunity cost, moving one commodity and storing a number. There may be a return on every crop out there, like we saw this year, but corn may have a greater return on storage than beans, or wheat may have a greater return. So as we talk with these guys, it's really what do we want to store, and that's going to affect ultimately where you guys can buy the grain. You know, what we're seeing now in Kansas City markets is there's always uncertainty in the hard red wheat market. The seasoned traders say you got to kill it 7, 12 times. I don't know how many times, but there's always a supply concern. Yet we see spreads today at wide values at carry, and if they don't know if they're going to have a corn crop, you never know out in Southwest Kansas. But their ability to go pay for grain today, they can pay a higher value because there's an opportunity to capture carry in their long space. So they may be paying a number today on their basis that doesn't make sense, but if they bought it today and carried it to July 2016, it sure makes sense to own it at that cheap value because you captured all that carry, all that return on your storage.
Nate, what are you using for storage costs and interest?
5 cents a month on storage.
Okay.
And interest, if you use 2% on the value of corn, for quick math, we're usually using a penny a month interest cost.
Okay.
It depends, where you guys are really borrowing money at. But if you think about it in those terms, right here, full carry definition, 5 cents a month storage. So if you're looking at the D-Smart spread, so this is something that year in, year out you can figure. D-Smart is, unless they change contract terms, is always going to have 15 cents of storage cost, storage carry. The moving piece year in, year out is the interest cost. So, interest rate at 2.25 almost is 3/4 cent a month. That's times 2 months, and you're going to have 17.5 cents of full carry. 3 months, yeah. So when we talk about full carry, the opportunity for the market to go to full carry, that's what we're calculating. And a rough number, again, more on the merchandising side, is if we have the opportunity to capture 70% of full carry, that's a pretty good return on our space. So if we saw that spread get out to 13, 14 cents, we may have a lot of unknowns still, but we know we're going to carry some grain to March. We may hedge in the March. That may be, from the origination standpoint, something where you see basis, Scott's buying everything versus the D's, and if you looked at your guys' equity run, there may be a lot of hedges sitting in the March, a lot of short positions in the March. That spread's wide enough to offer us a return, so we're going to capture some of that.
And the same thing to tell the producer right now too. There's carry in the market. That, a lot of you guys are talking to the producers, and a lot of these same principles apply. If it's good for our co-op to hold grain, it's also good for them to hold grain. Think of it in the same way. You're helping them. When you're talking to them, you can add some value to their whole, strategy by pointing these things out to them. Some of them might know them already. That's fine. It's always good to go through the exercise, but others don't necessarily see that, or if all they see is the nightly cash bid on the website and they're looking for $4, well, you and I know that it's going to happen a lot sooner in April, May, or now June, July than it is nearby. So those are good things to talk to them about. If you're going to get offers, those are going to hit sooner than the nearby.
Absolutely. So. And Jeff's going to talk about some outlook stuff to talk to him, but I think that's a great point. And coming from the origination side where I started at the elevator, I love that as a default answer. If it's good for the elevator today, it's probably good for you to look at. Now, sure, there's times where maybe we don't have the margin potential by letting them know that, so it's not, but ultimately, I think it comes back down to relationships. And if you're doing something that's good for them and they're calling you first, that's going to be a good thing. So when in an inverted market, free DP structure, to have an honest one-on-one conversation with that farmer, it probably means, listen, basis is high today, spread structure is inverted. Those two things alone are telling us the market wants beans today.
Yeah.
So, yes, you can put them on free DP, and you may have the opportunity for higher flat price down the road with no cost. So that's his choice. But, the simple basis side of it is the market's telling you, move that grain today, and you can kick the ball down the road, but the inverse and the idea that the market's going to free DP is telling us that the structure in the market is, I need grain today.
Well, that's been the challenge we've had all winter. We've come off of inverted markets, supply shortened years, and our farmer base here through the winters wanted a free DP,
Right.
especially on corn. Look at how difficult it is now. I mean, it's not good for the elevator.
Nope.
It is potentially good for the farmer because he can move it today,
Yep.
potentially forward price it, but we don't have space for it. So
So you guys aren't offering.
we're not offering it
We have
That's
free,
something to
well,
start-
and as
Well-
converse, we have free DP on soybeans
on beans. Yeah,
till October 1st. What
Yeah.
happens on the bid sheet if a farmer holds beans till
Exactly.
October 1st? They lose 40, 50 cents a bushel, right?
Yeah.
It's still not, like Nate was saying earlier, it's still not good for them to put them on free DP with the theory. All they're doing is speculating that they're going to go up for some reason.
and all Nate's saying is just tell them. I mean, we could show
Yeah.
them. We could show them that. Here's what we're going to do with them. If we get the free DP now, we're going to ship them. We're going to move them.
Yep.
So
And
they
that's
ought to be able
ultimately
to.
their choice.
Yeah.
But I had a customer in Iowa who called and said, I explained it, and the farmer in his mind at a soybean processor last year when it was, or 2 years ago when it was $3 over at Minneapolis soy processor. Well, I'm not going to move it on free DP because I know what you're going to do with it, and that's going to drop the price. And I'm thinking, they need 350,000 bushels a day to grind, and he's talking about 20,000 bushels. So, just because you tell them an honest truth that the
Yeah.
market's telling you to move this, they may have a theory of their own, but at least you're building that relationship. So, try to speed along here a little bit. That last, we noted what was on that last side. It's just, we just talked about it. Inverted spreads are telling us basis should be strong and the market's demanding grain. Carry spreads or market's trying to do the job of spreading that usage out over specific, deferred months. We don't need it all today. This is something we send out on a daily basis, and we went through the calculation, but the nice thing on this is we talked about that 70%. That's kind of a starting point. So we look at the rundown there. If you look at the D's March, it's total days. The storage rate is on the contract term is figured in a daily storage. If you were to go into deliveries, we won't get too much on that, but the 5 cents a month applies. So total river storage, 5 times 315. Interest rate, $2.45 or 2 cents, excuse me. Full carry, 17 and some change. So at the current day's close, back whenever this was, 10/25, it's a little dated, that spread was trading 68, 69% of full carry. So, 12 cents is a decent return on space. Then it's, that's the conversation you have. You're probably not paying that all to the farmer, but your bid structure probably is showing some carry in it. Two types of spreads that we really use most of the time, bull spreads and bear spreads. Bull spread is spread that buys the front month, sells the deferred month. In this scenario, when we saw these March trading at 13 cents, we made bull spread it. We're capturing that carry. We're allowing ourselves to take advantage of that return on space. This is also considered a substitute purchase. Why? Basis and spreads are related. If today's market structure is showing D's corn at this value, March corn at 12 cents greater than that value, a carry market, if basis firms up, it's probably going to narrow that spread or tighten that spread, telling the market, I need grain today. So as a substitute purchase, you're not buying that basis, but your protection against that could be trading a bull spread. If basis is going to come higher, that spread should invert. If you bull spread, or should narrow, invert or narrow. If you bull spread the market, capture carry at 12 cents, and basis firms and that spread comes into 4 cents, then you gained on that position. You bought a spread wide, narrowed up, you had the opportunity to lift it. Bear spread is the opposite. You're selling the front month, buying the deferred. Also considered a substitute sale. Same reason, basis and spreads are related, but a visual of that is, if you can calculate DVE at 6 over, all those moving pieces, and the Dees March corn set spread going into fall is only at 5 cents, yet basis on the river is 20 cents below delivery value. Something in that scenario isn't working. The spread's not offering us a lot of carry. The market's telling us they don't want that cash grain. There could be a lot of moving pieces in that, but by bear spreading that, you don't want to sell the cash that day. You don't want to sell that 20 under. That's a pretty cheap value. Maybe logistics tell us we have to do it. A lot of other moving pieces, but the bear spread in that scenario allows us to sell that spread with the opportunity of basis going higher, but eliminating our risk, our offset, if basis doesn't get better. So if basis goes to above DVE, we may be losing on that spread because we were already narrow and it may continue to narrow, but we should have the offset with a higher basis value. If basis continues to weaken, hopefully it's not getting lots weaker than what our spread opportunity there from 5 cents that we sold it to the full carry of 17 cents. A lot of moving pieces there. Bull spread risk is limited to full carry. That's one thing to just always know. And the reason behind that is basically this concept that because there's a set amount of storage paid on that per month, if the long futures were to stop grain and carry it, this is December, and they were to carry it to March, if the return on that physical receipt was greater than what they're paying that person in storage by not loading it out, plus the amount of money that it costs for them to borrow the interest rate to pay for that grain, because if you stop futures, you've got to pay the seller. Those two components, if the spread was wider than the cost of storage and the cost of interest, then everybody would go in, that's free money. I'd stop grain and sell it versus December, I'd stop grain and I'd sell it versus the March. And if the difference between the two, I know I'm paying fixed storage to somebody and I know I'm paying interest to borrow that money, if that return is greater than those two components, you do it all day long. The one offset to that, and I heard one of the, again, seasoned merchandisers say this, I didn't really think about it, but with funds in the markets today and with some managed money, there are scenarios where people don't have to pay, and interest as low as it is, there's scenarios where people don't have to borrow money to do these type of things. So if you take the interest component out of the equation because you're not using a note, you're not using any borrowed money to do that, then potentially you could see people heavily stopping, returning, capturing that return on grain because they don't have that interest component, that interest cost. Bear spread risk, unlimited. That's the scary part about bear spreads, especially in beans. There's no limit to the inverse, so if you sold today's futures and bought deferred, and it was at this type of inverse and that thing kept going higher and higher and higher because the market needed grain, couldn't get filled, pipeline couldn't get filled, then you're in a losing position. You better be able to sell cash, or you're going to have to roll and take a loss. You're going to have to roll that forward to a worth something less down the road, and there's no limit to that. And the chart that kind of gives you the visual is the no March bean spread. We're not talking old crop, new crop. We're not talking a huge span of time here. We're talking about a couple months here where November beans traded almost a 40-cent premium to March, and that is a visual of kind of that risk of putting a spread position on, unless it is for a reason, which hopefully 100% of the time